Hello friends, this is Danny Cadenbay with Church Hill Mortgage. It's December. We're looking at less than a week until the new year. So I want to talk to you today about what can we expect in the mortgage and housing market for 2023. All right, to begin with, what drives mortgage rates? It's going to be inflation. A mortgage is an asset that makes a regular payment on a monthly basis. Typically, it's going to be a 30-year mortgage. So that means that whoever holds that asset can look forward to 30 years of regular payments at whatever the interest rate designated on the note when that mortgage is taken out. If inflation is high, then what happens is the general price level goes up. It makes the payments on those mortgages not as valuable to the person who holds the note. So what they're going to do is they're going to raise the interest rate on the mortgage so that they can recoup some of the losses that get eaten away from inflation. If we look over the last 4 years, starting from January of 2018, you can see that on the top here, I've got the 30-year fixed mortgage rate. Underneath, I've got core consumer price index, so that's one of the government's measures of inflation. For the most part, let's look back in January 2018, you can see inflation peaks, mortgage rates peak. Inflation comes down, mortgage rates come down. Here we've got another peak. Here we've got another peak. Here, starting in 2020, inflation comes way down. That's because of the pandemic and the shutdowns that affected not just this country, but countries across the globe. At that time, the Fed engaged in some quantitative easing. They started buying mortgage-backed securities. Because they were buying the mortgage-backed securities, that brought the prices up, which brings the interest rates down. So you can see that the mortgage rates here are continuing to go down through 2020 and 2021 and staying relatively stable at around 3%, which is what the Fed wanted. But at the beginning of 21, we started to see inflation peaking. It peaks and continues to go up. But during this period, remember, it was all over the news, announcements that inflation was going to be transitory. We didn't expect it to stay. So because the Fed didn't expect inflation to stay, they continued their quantitative easing, which kept mortgage rates low, and they failed to track inflation the way they usually do. When the Fed quit that quantitative easing and let the markets take over, you can see starting in 22, we had a rapid rise in mortgage rates, and they peaked at just above 7% in November of this year. Okay, so inflation drives mortgage rates. So if you're waiting for mortgage rates to come down, what you're waiting for is for inflation to come down. When is it going to peak? Our numbers suggest that it's already peaked and it's already coming down. Let's look at this chart here and let's try and understand what's going on. When the CPI numbers get reported, they get reported on a monthly basis. So when we see the report for November, we're looking at prices in November of 22 compared to prices in November of 21. We can see that in November of 21, inflation was 0.5% on a monthly basis. Now, in 2022, we're looking at 0.2% on a monthly basis. So that's way down compared to what it was in November of 21. So when that report hits the markets go, yay, inflation's coming down. And what we see is an ensuing decrease in the mortgage rates. So if you look at this chart, this is going back over about a year and a half here. So we had way high numbers in June of 21, dipped a little bit, and then stayed high from October of 21 all the way through about June of 22, right? So you can see those pretty high numbers here right in the middle of my chart. But then in the second half of 22, we started to see those numbers coming down again. And again, the important thing is, what is the number in this year relative to what that was reported last year? Because that tells us where inflation is at the moment, and that tells us what to expect about rates moving forward. So you can see September in 22 was higher than September in 21, rates were going up. November of 22 is lower than November of 21, rates had peaked, and they've already come down over a full percentage point in the last 30 days. So we can see that those rates tend to come down as inflation comes down, and it looks like inflation's already peaked. All right. What's keeping the inflation numbers high? There's one number that tends to keep the inflation number pretty high. It's a lagging number. It's called the shelter costs. So you can see shelter is 39% of core CPI. So again, core CPI, that's just one of the numbers, happens to be the Fed's favorite number for reporting interest rates, or excuse me, inflation rates. So shelter costs are a lagging number. What that means is, even though the cost of shelter could be coming down or really just not growing as fast as it used to be, because leases tend to be long, typically a year or longer for housing, there's going to be a lag in the reporting of those numbers. Since those numbers make up 39% of the CPI, the report on inflation, what you're seeing is that even though here in 22, the shelter cost rate of increase had already peaked and was coming down, it hasn't quite hit the core CPI. So we're gonna be looking at a couple months still of those high reports of inflation, even though other indicators are suggesting that for the most part, it's under control. So here I've added in blue here, the CPI rent year over year change. So you can see how the list rent in purple is peaking up here in January of 22, and you're seeing CPI rent starting to go up. Here it's coming down in the second half of 22, and so what we're going to expect to see is this CPI rent number start to come down in the beginning of 2023. So one way to think about shelter costs is kind of like a roller coaster. So January, those shelter costs were peaking. Here in December, real shelter costs are already coming down, but the tail end of that roller coaster, representing what shelter is doing in the measurement of CPI, that hasn't quite peaked yet. So that's got to come up, hit that peak right here in the center of the roller coaster, and then we'll start to see it coming down in the ensuing months. Okay, so to sum up, what's going on with inflation? All segments are lower except shelter. Again, shelter is 39% of core CPI, but we see prices have come down across the board for food, gas, clothing, and the other elements of the CPI index. All of these are already reflected in the CPI. Shelter costs, although decelerating, are still showing increases in the CPI due to the lag effect. Don't worry about it. Numbers are going to go up for a little bit, but they are going to start coming down. Okay. So now I want to talk to you a little bit about how the 10-year Treasury bond is related to mortgage rates. All right, this is a 35-year history. We're starting in 91. We're coming all the way to the end of 22. So historically, the normal spread between the 10-year Treasury and mortgage rates is about 175 to 200 basis points, okay? So, and if you look at this graph over this 35 years, that spread hardly ever changes. It's almost as if somebody just took a copy of the 10-year Treasury and slid it up by about 175, 200 basis points and turned it yellow and said, hey, those are mortgage rates. That's what's more typical. But as we all know, the last 2 years have not been typical. So these numbers haven't quite stayed where they usually are, and we started to see things get a little bit wonky. In 2022, the spread between mortgage rates and the 10-year Treasury was 300 basis points. So that's almost double. Well, I guess if you round 175 down and 300 up, but anyways, it's a lot more than it usually is. So what we're seeing is that, oops, sorry, jumped ahead of myself. So what we're seeing is that where the 10-year Treasury was just around 4%, typically we'd be seeing maybe 6%, maybe just shy of that in mortgage rates. The reason why the spread has jumped so much is because of what inflation has been doing and the anticipation of decreasing rates in the future. So where does this spread come from? It comes from servicing. Now, here's something that you might not know about mortgages. The company that you take your mortgage out with, hopefully it's Churchill Mortgage, maybe it's your local bank, they typically don't actually keep the mortgage. They're going to sell it on what's called the secondary market. However, somebody has to service that loan. Servicing means collecting your mortgage payments, making sure that your taxes are paid, making sure that your insurance is paid. That's what servicing is. And there's a company that does the servicing and they collect a fee from the person who holds the note. So here's what happens when you have a mortgage. You get a bill and it says, make the check out to this person. You say, okay, cool. So you make the check out to whoever it says, you put it in the mail. They're going to take that check. They're going to apply it to your account. They're going to deduct the relative amount of principal owed and interest and all that other stuff. They're going to put your money into escrow, and whatever's left over, they're going to send over to the person who actually owns the note. Okay? You don't ever talk to them. So the business of servicing mortgages, they got to make money somehow. The way they make their money is by that spread between the 10-year Treasury and the mortgage rate. In other words, you charge a little bit higher mortgage rate. That way, once you pay the servicer, you're still making a reasonable profit so that, you know, all of your numbers work out. Because so many of us in the industry and the people who buy and sell mortgage-backed securities, because they can see the signs that inflation is going to come down, they're anticipating that these mortgages are not going to last the full 30 years. So if they're not going to last the full 30 years, people are going to refinance relatively quickly. The value of servicing that mortgage is significantly decreased. So you still have to pay for it, but since the value is decreased, what do? Well, they're going to hold rates high now so that they can recoup some of those servicing costs over the next 6 months, 8 months, while they brace themselves for you to just refinance and take advantage of the lower rates that we're anticipating in 2023. All right. Already, we can see in December that this spread is starting to narrow. So if the spread were to come back to a more historically appropriate average, like I said, we're looking at the 10-year just under 4%. So what does that mean? We'd be looking at rates just under 6% right now. We're not seeing that, but it's starting to get closer. Okay. So what else do we see for 2023, and how is that going to affect the housing market? One thing that we know for sure is a recession is coming if it's not here already. How do we know that? First of all, let's look at the credit card and other revolving debt in the United States. You can see that it was growing steadily from 2018 all the way up until 2020, and then whoosh, massive drop. What happened? Well, in January of 2020, we got a whole bunch of stimulus checks, or at least they talked about them. I don't remember when they actually came through. Was it March? Anyways. So what happened was economy shut down, people stopped spending money, and then we got 1, 2, 3 stimulus checks from the government, which when you combine not spending money to getting a big old fat check in the mail, what do? You're going to pay off your debts. Why wouldn't you? There's nothing else to do with it. So during the pandemic, we saw a major decrease in credit card and other revolving debt, But what's going on? Inflation crept in and prices started to go up. The economy opened up. People wanted to get back to their lives, but wages haven't kept up with inflation, and that savings has been eroded. So we can see that the savings rate in 2022 is actually, well, you can't see it on this graph here, but it's actually about what it was, if not lower than before the pandemic. And the reverse of that is credit card and other revolving debt is way up. So what does that mean? There's a limit to how much we can keep that up. Credit cards have a maximum. They've also got a minimum monthly payment. You don't make those, you get cut off. You can't contain the consumption. Consumption's going to drop. When consumption drops, that's a big component of GDP, and whoosh, recession. All right, what are other signs that we're expecting a recession? Let's look at the 10-year minus the 3-month yield curve. Right now, it's called inverted. What does that mean? Typically speaking, if you're buying an asset, you expect that you'd get a higher interest rate if it's a longer term asset than if it's a shorter term asset. Just look at what you get on a treasury bond versus what you get in your savings account. If you're like me, your savings account is paying like 0.01% maybe on a good day, right? It's basically nothing. It's not even enough to justify the hassle of having to go in and click on the button to check what your statement is. Okay. However, if you buy a CD, maybe you get 2%, maybe you get 3%. I don't know what the rates are right now. I haven't checked recently, but you can see that generally speaking, the longer the commitment to the asset, the better the interest rate, right? Well, when the 10-year is actually lower in the interest rate that it pays than the 3-month, we call that inverted. We call it an inverted yield curve. What does that mean? That means recession. Look at my graph here. Starting in the 1980s, we've got, so the difference is going to be less than 0 whenever the 10-year drops lower than the 3-month. So here we're pretty close to 0, and then this shaded area is a recession. Let's look over here in the 90s. We've got an inverted yield curve right down here, recession. Now we go over to the 2000s. We've got an inverted yield curve and recession. Here we did it again. That's the financial crisis, inverted yield curve, recession. We had an inverted yield curve coming up on 2020, boom, recession. And you can see right at the end of my graph here, we're inverted again. So what does that mean? It means a recession, like clockwork. So, as I said, if we're not in a recession now, we're heading into one in 2023. All right, now let's talk about housing demand, which is formed by household formations. What's a household formation? Think of it when the kids grow up and they move out and they get their own place. That's a household formation. It's not the same thing as population growth, but it sure is driven by population growth. Typically speaking, household formations is at the rate of about 1.75 million annually. However, we're down here at 1.3. So what's going on here? Well, rent is really high, home prices are really high, and mortgage rates are also pretty high. So you put all of those things together, and there's a lot of people who are saying, hey, you know what? Mom's basement isn't that bad. At least I don't have to pay rent. So they're not forming households. They're waiting until conditions get a little bit better. So the way we see this part of the graph here, this difference between the standard of 1.75 or 1.7 and the current of 1.3 is that's pent up demand. Okay, so that's people who want to move out, who want to get their own place, but they're not because at the moment they can't afford to, but we expect that to change. All right, so we talked about demand, let's talk about supply. Housing starts completed are at 1.5 million. However, every year, some houses have to get torn down because they're just not repairable anymore. That's at about 0.1 million or 100,000. So when you take the difference, you've got 1.4 million actual new homes available. So we've got household formations at 1.3 million annually, but total new supply at only 1.4 million. So what that says is, yes, supply is greater than demand, but not by a lot, and not compared to the historical average, right? So when supply is less than demand, what does that do? That creates a shortage, and that drives prices up. So one thing that we're expecting in 2023 for the housing market is steady or increasing home prices, right? So you see it in the media a lot. Are we in a housing bubble? Has the housing bubble popped? Are housing prices coming down? Or maybe they'll be like, hey, housing prices already are coming down. But we're seeing that the underlying factors that drive home values are still strongly leaning in the direction of increasing prices. Okay, so right now, what do we have going on with housing prices? If you look, since about 2013, we are up 115% in 10 years, okay? So now let's look at just what's happened since the pandemic. In the last 2 years, we're up 39%. That's enormous, right? What's happened in 2022? Down 2.5%. All right, so if you look at this graph, yeah, sure, there's a little bit of a peak at the end of 2022. But if you look at where we are compared to where we were just a couple of years ago, we're still way, way up. Another thing that I want to show to you on this graph is here again, we've got the pandemic shutdowns, right? Recession, general craziness. You can see a kink where the home values jumped up at a much faster rate in 2020 and 2021 than they did for the majority of the last decade. Well, remember, quantitative easing pushed mortgage rates to a historic low. Some of them, you know, if you were one of the lucky ones, you got locked in at under 3%. Okay, that was essentially nothing. That was less than inflation. So it was almost like somebody paying you to take out a loan to buy a house. Pretty great stuff, right? So what we saw was historically low rates combined with a lot of people saying, hey, you know what? I'm not comfortable living in a big household because that's more risk of me catching or spreading the coronavirus. So you saw an increase in demand on a massive, unprecedented scale during that pandemic. So that shot home values way up, right? But if we were to average that out and expect things to come back to normal, right, you can see that there should be a little bit of correction, but a correction is not the same as a crash. All right. Now I want to talk about affordability. In many ways, this is the most important feature of the entire housing market conversation, okay? People are going to buy as much house as they can afford. If they can't afford the house, they don't qualify for the mortgage, they can't buy. Okay, so last year, what was typical on the market? We had a typical loan amount of $400,000 at a rate of 3.5%. That equals a monthly payment, that's principal and interest, that's not including taxes and insurance, of $1,796. All right, from last year to this year, we saw 10% appreciation. So that means that if you were borrowing $400,000 in 2021, you were borrowing $440,000 in 2022. Rates also went up by almost double. So the difference in your monthly mortgage payment would have been $913 for the same house. So that's because prices went up and mortgage rates went up. That's a huge amount of money. However, what is affordability? It's how much of the money that you have are you able to devote to housing? Well, typical household income in 2021 was $9,000. So $9,000 might be two people making 50 grand and pooling their income. All right. However, the ADP says that people who stayed in their same job on average got an increase of 7.6% in their wage or salary. People who switched jobs got 15.1% increase. So that averaged out to 9% increase in your income. So we've got 10% appreciation in the value of the home, almost double the increase in the rates, but an average of 9% increase in your income. So what did that do for you? That meant that instead of $9,000 take home, you were taking home an extra $810. That's pretty nice, for $9,810. But you had to pay $2,709. So that was actually more money going to your housing than you actually made in the raise that you got from your job. So that wasn't too great for this year. Another factor that was suppressing demand in 2022. Okay, so here are just some other numbers. Gasoline, food, services, monthly average, a total of 1,154. If you got a 5% increase heading into next year, that would be an additional $1,300 for a total income of $10,300. Well, when we look at that, next year we expect home prices to be roughly steady, maybe 1 or 2% appreciation depending on your area. But with our forecasted 5% mortgage rate, that's giving you a payment of $2,362 for that same house. And you're getting an extra $1,300 a month. So total increase of $807 in your expenses, but an increase of $1,300 in your income. That's leaning more towards saying, hey, yeah, homes are actually more affordable next year than they were last year. So that's pretty great. All right, so to sum it all up, what do we see going on for 2023? First of all, we've got lower inflation, right? CPI numbers are already starting to show everything but housing costs have started to come down. And we've seen that those housing costs in real time are coming down, which means that in the CPI, they're going to start coming down over the next couple of months. Awesome. What else do we see coming in 2023? Recession-like slowdown. Whether or not it's a recession depends on whether or not the government wants to call it, but all factors are indicating that economic activity is generally already slowed down and it's probably going to slow down further. What does that do? That drives inflation even lower. Lower inflation means lower mortgage rates. Incomes, on the other hand, are expected to continue increasing, not at the rate that they did in the last year, but, at a moderate pace. So the combination of those two things, lower rates and increased income, we're expecting increased affordability. We still expect inventory to be very tight. We're barely making up enough new homes to house the new household formations that we're seeing. And when all those people who are sitting on the fence jump back into the market, we could find ourselves in a very tight supply situation again. And then on the other hand, you got to live somewhere. If you don't live in a house that you own, you're going to live in a home that you rent. Rents are still historically expensive and they're still rising. So all of these factors together are indicating higher demand for homes in 2023. Low single-digit appreciation for most of the U.S. will probably hold steady through 2023, but we'll see a pickup in activity. What do we see for mortgage rates? We got some headwinds working against us. We've got global quantitative tightening. At the same time, we've got a lack of foreign central bank buying. So these are two activities that, as we mentioned in my previous slide, call it quantitative easing. It tends to depress mortgage rates by increasing the activity in the mortgage security market. We've also got more debt needing to be financed. All of this is working against having lower mortgage rates. On the other hand, we've got some tailwinds. We've got lower inflation, lower by a lot, in fact. We've got excess retail inventory, not a lot, but some. I just spoke a silly. Retail inventory, not home inventory. We're seeing excess retail inventory across multiple industries. We're also seeing an increase in mortgage servicing value. So as we spoke about it before, if the servicing value of the mortgage goes up, that means that people are more likely to stay in their mortgages. That means that the banks don't have to charge you as high of a premium at the outset in order to cover their costs. So that's going to bring rates down. And then, as I mentioned, a recession is likely, if not already here. Rates almost always decline during recessions. Again, barring any kind of quantitative easing type interference. All right, so to sum that up, 30-year fixed mortgage rates moved near 5% during the first half of 2023. The US 10-year is going to be near 3% or lower. So that's what we're seeing. That's what all the signs are pointing to for 2023. So I want to thank everyone for sticking through 2022 with me. It's been quite the roller coaster with ups and downs, craziness going on in the mortgage market, craziness going on in the housing market, but 2023 is going to be a great year. I hope everyone is well, and I will see you at the new year. Have a good one.